Hello and welcome. We don't know how the future will be, and definitely we don't know what the future of currency will be. Currently, the world economy is dominated by US dollar, but are there any chances that it can be replaced by virtual currency or digital currency? Will people at large possess more digital assets over the traditional ones? Well, I'm going to explore the same in this session with Ronit Ghose and Rehan Ahmed. Gentlemen, glad to have you here.
Thank you for having us.
Thank you, Amol.
So, I would like to shoot my first common question to both of you. And Ronit, I will start it with you first. So the question is, with the growing digital adoption in the payment space, not only in India, but and the Middle East and the Asia, but all over the world, what do you think will be the future of the currency?
Sure. Thanks for that question, Amol. Most of us live in a digital world. Doesn't matter where we are in the world. If you live in big cities or if you're from a younger generation, we spend most of our lives online, on our phones, digitally. What's interesting about the point in time we're kind of living in right now is we're sort of transitioning from digital money or digital 1.0 into digital money 2.0. Just like people say we're transitioning, could be transitioning from Web 2.0 to Web 3.0. Now, all of us have grown up with or use internet banking, credit cards, digital wallets. This is all digital. But that variety of digital money is something I call digital money 1.0 because it's basically taking the existing financial system that's existed for centuries and putting it online. Let me explain what I mean, and I'm sure Rehan will have thoughts as well on this in a second. But if you think about modern finance's roots go back, for good or bad, to sort of Renaissance Italy. The word bank, so I happen to work for a bank, the word bank comes from the Italian for bench. There were folks sitting on benches in Renaissance Florence and Venice with notebooks, literally with books. You'd have credits on one side and debits on the other side. And double entry bookkeeping, I think some monks invented it. But anyway, double entry bookkeeping, this was the basis of early modern finance. Roll forward several centuries, 6 or 7 centuries, what you start seeing is around the 1950s, 1960s, the invention of mainframe computerization. It starts in the military, in the government, and banks are early adopters of this. So late 50s, early 60s, you're sitting in the US or in France or in the UK, these were the early adopters. They took the existing financial system, that literally double entry bookkeeping. Old school bankers and many people in the industry still talk about banking books, ledger entries, diary entries. They took that physical process from the Gutenberg age, the Renaissance age, into the computer age. And then in the 1990s onwards, we kind of created the system that we all live in, whether it's in wholesale banking or retail banking. When it comes to digital money 2.0, it's a very different story. It's the story of tokenized money. It's a story of programmable money. It's a story that goes back almost to, you could say, a combination of Bitcoin, the Nakamoto white paper in 2008, and also subsequently the various different forms of decentralized digital money and now centralized digital money that is emerging. And that has huge differences. It's programmable, it's tokenizable. It has huge differences to digital money 1.0, and it creates all kinds of implications for money, for finance, for society, for politics. But I'll stop here because I could talk for an hour and that wouldn't be fair in the audience. They'll be asleep. So maybe you want to get Rehan into the conversation as well.
Sure. In fact, I think you started off really well with the background story. I think you added some spice into it and the history and geography also in the future of currency. Rehan, I will shift the focus to you and we'll take your views as well.
Thanks, Amol. So very articulately put, Ronit. And I couldn't agree more that we are definitely in currency 2.0. But also, how do you complement that to asset 2.0? So again, in the very same way you have money. And today, a few years ago, we were thinking of banknotes. We've moved to digital cash in our phones. Now, the next level you're looking at is programmable money. The question I find asking myself is, so far, this money has been spent in the institutional manner on paper assets. So how is it that assets will actually become more digital to be able to support digital cash is a question I often ask myself. Another interesting thing to think about is a lot of the released central bank digital currencies so far have targeted retail, essentially M0. I'm personally quite curious to see how the institutional and the wholesale space plays out. And what are some key advantages for that, right? And on the retail side, when you look at essentially the use of digital currency, how is it that governments will actually reward behavior and reward good behavior, right? That's something that interests me a lot. So definitely, I agree we're in Cash 2.0 in a Web 3.0 world. It'll be fascinating to see the nexus, but I definitely think it'll be, the play there will be, how do you reward good behavior with cash that is then spent on programmable assets that builds a very virtuous loop. And we can go through some examples in this a bit later.
Noted your points, Rehan, and let me shoot some specific questions to both of you. To begin with, cryptocurrency is a trending topic all over the world. And let me tell you, in fact, Ronit and Rehan, a lot of people call me and ask me, because we do a lot of coverage on the cryptocurrency, should I invest in cryptocurrency? Should I buy Bitcoins? Will I get more returns? Something like that, And I often tell them, don't buy cryptocurrency, invest in my account, which they don't. But, let me take, and Ronit, I will come back to you and take your specific, perspective specific on the cryptocurrency. So my question to you, Ronit, is how far cryptocurrencies will go from here? Will it replace the current structure of the currency that we are seeing in the market, in the world economy?
The short answer is not in the foreseeable future. No, it won't replace. But it's a much longer answer. So you've got to go back to sort of 2008, 2009, so the white paper, the Bitcoin white paper, and Bitcoin remains the dominant or the largest decentralized cryptocurrency in the world. Depending on the day, it's going to be worth 800, 900 billion plus or minus. There's about 2 trillion, just over 2 trillion of decentralized crypto assets out there in the world. Again, this moves a lot. And this is the first point to mention. It's still a relatively young technology, and the value attached to it is based on supply and demand. So it's an asset. It's the way I think about it, just like a bond, a real estate, a piece of art. It's an asset where the price is set by supply and demand. Now, if you hold a rupee or a dollar in your hand, or a dirham, because I'm based in Dubai, if you hold a banknote in your, most of us don't, if you do hold a banknote in your hand, actually most banknotes are hidden under mattresses, but that's another story. We're going to talk about digital for the next 45 minutes or so, 35 minutes, but actually the number of banknotes in the world keeps going up. That's another dirty secret, but they don't actually circulate. They sit under mattresses. But if I have a banknote in my hand, I know what the value of that is. Now, of course, purchasing power over time can be eroded by inflation. But in the short term, that day, unless I'm living in Zimbabwe or Weimar, Germany, I know that at the end of the day, it's still worth what it's worth today. Now, the volatility of a financial asset, and that includes decentralized crypto, is significantly more than fiat currency. That's the first thing to remember. And that makes it hard from a payment perspective to use it as a payment asset. Though originally in the white paper in 0809, the subtitle was it's P2P cash. It was meant to be a digital version of the banknote. It solved the problem, which is online. And this is a problem that the original inventors, if you could say almost inventors of the consumer internet, were grappling with in the 80s and 90s. How do we have unique value online? Because everything is copy paste online. And it was only solved, if you like, in 0809 with the Bitcoin white paper. Now, subsequently, there are thousands of other decentralized cryptocurrencies that have emerged. The one thing I would mention is, if you've been lucky enough to be invested in most of them, or at least the big ones, you've made a lot of money. So maybe you have, or your friends have, but you have to be careful about their track record. Now, if you're technologically savvy, you can go and check the code, because ultimately the value of that cryptocurrency is going to be based on the value of the technology. If the code works, it's got value. If it doesn't, and we've seen examples of, bugs in codes, whether it's in crypto or others. Machines fail, software fails, code fails, or humans interacting with, when they're doing the code, they make mistakes. So you've got to be sure that, now likelihood is that you're not in that small percent of the population that can go and check the code. In that case, the other way to do it is just check usage. This decentralized crypto has been around for 4 years, 6 years, 12 years. It hasn't been hacked, or it seems to have use cases. Use cases are going to drive the long-term value. It's like a network. Now, Is it going to be a payment tool in the short term? No, because it's too volatile. The second issue is legal tender. To be useful as payments, payments, and particularly in the retail space, in the consumer space, it normally needs to be legal tender. In many countries, the legal structure doesn't exist to accept crypto as legal tender. So there's lots of interesting, there are lots of interesting use cases, whether it's as an investment asset, whether it's as a sort of expression on the value of technology, whether it's in terms of having the native currency of the internet. In a way, this is the native currency of the internet. But I wouldn't want to give any investment advice in this call. That's probably best done between you, the viewer, and your investment advisor. So caveat emptor, but it's a super interesting technology.
I think you raised 2-3 very valid points. Legal tender is going to be very critical. But as you mentioned that it's early technology, there is a huge scope to develop it. And that's why regulators are worried, but people are happy at the other end. So I think it's a very interesting perspective here, Ronit. And Rehan, let me tweak that question and let me understand the pros and cons, not only of the cryptocurrencies, but also the digital assets. So if I could phrase my question, what kinds of digital assets people would like to purchase going ahead, and what are the pros and cons of digital assets?
So maybe I'll add on to what Ronit was mentioning, because he started off too interesting a track for me not to say anything. So I think when you look at digital currencies, right, either, and you think about their future use cases, either you can think of them as investments or currency. And if you think about the standard definition of a currency, either you're looking at a medium of exchange, you're looking at a store of value, or you're looking at a unit of account. I think the investment, when you look at the fork I mentioned earlier, the investment piece, today, as Ronit was mentioning, 800 to 900 billion, and then 2 trillion for the entire digital asset universe outstanding. I think that question is answered, right? The question from there on is, at what point does serious institutional adoption really come in for crypto? So, I read a stat the other day that 3% of the world's population now has a digital account, right? So the question is, when do the large fund managers, when do they start accepting crypto as part of their mandates? And we don't know that just yet, right? But B, when you look at use of crypto as currency, let's go back to parts of the early 10s, and what the thesis there was, right? The thesis was, if you want to look at cross-border remittances, and if you think about, for example, offshore Filipinos living in Dubai, right? They want to be able to send money back home, depending on what kind of a money changing service they use. There's a lot of intermediaries along the way. And the thesis was that by using Bitcoin, for example, or any digital currency, you're able to cut off the middle layers, right? So I think regulators, especially in ASEAN, have actually been a lot faster to solve these issues, which make me a little bit bearish, right? So if I use Philippines as an example, there's a very interesting platform called bonds.ph. It essentially allows overseas Filipino workers to be able to send remittances back home, but also invest their remittances in local government bonds, right? So I think the Bitcoin maximalists have their own argument, but I don't want to underplay the speed of innovation, at least we've seen in this region over the last 3 to 5 years, that really goes at the pain points, right, that I just mentioned. And a lot of these pain points, frankly, may or may not have a DLT angle, right? I mean, one very good example between India and Singapore is a few weeks ago, it was announced that Monetary Authority of Singapore and the UPI in India are actually going to forge a connection in 2022. That is supposed to be mobile payments between two countries in the same way that Singapore has done with Thailand, right? So it's very interesting to see the regulator response. I think it's really gone down to the core pain points. And I think it's your original thesis is probably a while away, right? Where you see cryptocurrency replacing these traditional payment channels. Now let's start thinking about what kind of digital assets that people like to hold, right?
Right.
And there's that old saying, right, by Henry Ford, that if I asked people what they wanted, it would be a faster horse, right? I think at this point, it's very difficult for us to imagine what we really want. right? Back in 2008, I did not know I wanted crypto as a personal investment, right? I think we have to flip the story the other way around and start thinking about what are assets that really benefit from tokenization today, right? Are they assets that are traded on large liquid exchanges globally? Probably not, right? Are they assets that sit in heavily paper form, in a very physical form, and traditionally have lacked access into larger markets, such as institutional investors? Probably. And some of the themes I really see coming out by the financial institutions, frankly, on a global level, the assets that seem quite ripe for this tend to be digitalization of trade finance. They tend to be digitalization of lending products, such as loans. But when you look at private markets, that's another interesting use case, right? So how, for example, do you have a larger investor base coming into PE funds? Is that possible when you have fractionalized assets? So my world is a lot more focused on digital representations of securities versus currencies. And as I think about all of the innovation work that many banks we work with are looking at, these are very, very ripe. Because again, they lack a central infrastructure, right? And if the idea is that you can use next generation technology to build a central infrastructure, by definition, that should actually increase your accessibility, right? So I think the areas that I mentioned earlier, which is looking at trade finance, looking at loans, there seems to be both at least a supply push at this point in time, and hopefully consumers are actually, institutional investors, see the value in diversification of these assets and come on as a result. It's a long-winded answer, but
it's really meaningful, and I think I'm sure the audience will like it because it's a different. You highlighted some meaningful thoughts here. Thanks, Rehan. Ronit, you already heard, Rehan, about digital assets. He kind of mentioned the pros and cons of it. There are, few countries which are looking at digital currency far more aggressively. But if you look at India or Singapore, they have a different view. So, for example, Indian government or Indian governor of RBI, Reserve Bank of India, clearly said that we are not supportive to cryptocurrency, but we may think about the digital currency of our own. Considering all these different perspectives of the regulators, I want you to tell us, what is your reading about the regulators? How are regulators looking at digital assets and the virtual currency? You may talk about your region also. I mean, how the regulators in your region are reacting to 10 overall. You can compare it with the world.
Sure, happy to. And before I sort of get into the regulatory side, it's probably worth for your audience who don't know me or don't follow me, there's no reason you should do, just a sort of health warning. Everything I'm saying in this session is my views as an analyst. I work for Citi Global Insights. I do not represent the bank. So just that health warning. Now, in terms of thinking about the regulatory framework, you have to think about decentralized crypto, i.e. where no one in inverted commas is in control. It's done through a network. It's done through a process for Bitcoin called mining. It's basically a network of computers solving a complicated algorithm. And centralized crypto, which is basically stable coins, or more likely to be, when it comes to the government or the central bank digital currencies or centralized CBDCs. So these are very, very different. They have some shared aspects. So you can have centralized digital currencies, like say the DM token that Facebook and friends were developing, or CBDCs that are mainly in trial and pilot. Those can be on blockchain. They don't have to be, but they can be on blockchain. Obviously, decentralized crypto is on blockchain, on different chains, but it's on blockchain. So there's a technological similarity. There's also the similarity of what's called programmability or tokenization, but there are very big differences, and they kind of help answer the question that you're raising, which is that central institutions, be it the central bank, it's in the name, the Ministry of Finance, the government, or big companies, historically, at least in the 19th and 20th century, they've been built on centralized control. Now, the blockchain, and even actually Web 2.0 and Web 1.0 originally, which we forget, is built on decentralization. It's the opposite. So there's a huge philosophical issue here. And it's also got practical implications, because a regulator likes to know who's in control. So in many countries around the world, you have something called a In the UK, it's called the senior managers regime. You make a mistake, you're liable. And that's the kind of, in most countries, the banking system works that way. If you're a bank CEO or a bank director, there's certain professional and sometimes even personal liability. They know who to go to. Same if you're a client, you go and open an account in a bank anywhere in the world, there's a process called KYC that's done. And then later on an ongoing basis, AML and other processes, those are based on checking the identity of the individual. KYC is know your client. Now, in a blockchain world, in a decentralized crypto world, you're talking about a pseudonymous, sometimes anonymous, but mostly pseudonymous world. So there you're in a world of KYT, not KYC. Know your token, not know your client. On the blockchain, sometimes in social media, your identity is not obvious. Now, regulators don't like that. So regulators need to get comfortable with this. Now, obviously, there are tools and techniques that have grown up in the last 12 years to make regulators, to arm regulators, to help them find, quote unquote, bad guys on the internet or bad guys on the blockchain. And there's been a lot of progress done. So nowadays, frankly, if you're a bad guy and you're trying to do a hack or a ransomware, you probably shouldn't be using Bitcoin because the chances of the feds catching you are much higher than they used to be. So, but there are other current, there are other coins, so-called privacy coins you can use. So there's this issue actually both very fundamentally and vis-a-vis the current, if you like, the current legal or regulatory structure. Blockchain raises all kinds of questions. Now, part is a response to a lot of policymakers take the view, well, we don't feel comfortable with this, but we can't ban this technology. So let's adopt it. Let's, like almost tame it, create our own version. The horse is very valuable, but if it's running wild, we can't use it. So let's tame the horse is the idea. And so you have this CBDCs and to some extent big tech and their stable coins. That's the idea. You're taming the horse, try to keep some of the value, but putting it into the existing structure. CBDCs amongst big countries, they're furthest ahead in China. For the last 18 months, you've seen trials, pilots in the wild, in actual cities, over half a dozen cities. In most parts of the world, it's still in white paper stage, discussion stage. It's committees and coffee and cookies stage. So there, I think based on data from Basel, Bank of International Settlements, something like 85 or 86% of the world's population is living in a country where the central bank's working on some kind of CBDC. Not many actually have it live. The Bahamas have it live. I think Nigeria is going to go live soon. Not many have it live.
Right. I think very valuable insights I'm enjoying, and learning a lot from both of you. Rehan, let me come back to you. And, when you look at a lot of Asian countries, and specifically India, actually, it's the youngest country. And that is why the adoption of digital is very, very high. So there might be a trend where people do not want to invest in cash, or they don't want to carry cash, but they want to carry the digital currency. In fact, many youngsters, or specifically the people, those who are investing in the cryptocurrency in India, are the millennials one. So my question to you is, when the digitalization is happening rapidly, when the globalization is at a next level already, do you think it would be a good idea to have a virtual currency? Because carrying a virtual currency, maybe just a contract or a number that happens with cryptocurrency, is far more easier than carrying a cash when you're traveling across borders.
Sure, Amol. So that's a big question. Let me try to deconstruct it in a few ways. Is it more convenient? Yes. Is it fundamentally different as a user experience versus someone who travels with a credit card? It's a question for the end user. Absolutely, right? But let me take your question on, the India and what are some interesting lessons I'm actually seeing that could have global implications, right? So you mentioned earlier about India and crypto. Recently, there was a release by SEBI about usage of ability for depositories in India to be able to use blockchain technology for recording of covenants, right, and monitoring of deals. I actually think this is a little more profound, right, and maybe the nuance is lost. So what happens is that typically when you look at bonds and loans, just in layman terms, they come with conditions. They come with repayment conditions. One of the things you see lately in many parts of the world is sustainability conditions, right? for issuers that are trying to transition into a more green future. So here is the first use case that I've seen where a regulator is actually going out there and saying that it's important to be able to record these. And the app technology, so far when we talk about digital currency, we always just think about crypto. But actually you forget about the smart contract layer and you actually forget about the ledger, which is part of the entire tech stack, right? So one use case that I see is if you have virtual currency that is able to interact with programmable assets that are able to give the end investors full transparency. I think the question goes beyond, are you able to spend cash in different regions, right, or different parts of the world, which I think during COVID times is probably, a bit the idea is a bit academic of travel, right? I'm really taking the angle that how can you build a more transparent product to end investors to invest in, right? And I think that whole world opens up when you start looking at the usage of programmable money with programmable assets. So one good example I'd like to use is, could it be that if, for example, if large corporations are able to issue sustainability-linked bonds, right? And these can be distributed at a retail level. And investors who truly care about this cause are able to record their impact on a real-time basis, right? For example, what is the reduction in greenhouse gas emissions, right? The ability for them to see how their investment has led to a reduction in greenhouse gas emissions. I think these are themes that, the future generations will worry a lot more about versus whether they're using virtual currency or, something equally apt as payment rails, right? And, we see this a lot in, the robo-advisors, right? There is no shortage of ESG and impact portfolio options. I mean, they're almost coming up as a fiduciary duty, right?
Right.
It started very much on the institutional investor side, and I've seen this come down into retail in a very big way in this region. So maybe I'd try to shift the question a little bit. The question is not really virtual currency, yes or no. If it's faster or quicker, the end user doesn't care. But when you look at Asia as in terms of the overall demographics, when you look at the growing middle class, and you start thinking about where they're going to invest their savings, I think the choice becomes a more conscientious one versus 1 or 2 generations ago, right? Now I think the feel is more, they want to see their investments impact the world in a meaningful way. So these are some of the themes I'm starting to see versus digital currency or not.
Noted, Rehan. Ronit, one more important question I have for you is how the BFSI companies or the financial institutions are looking at virtual currency or, the whole digital assets or the whole virtual world in terms of the currency.
For existing banks and financial institutions in the so-called TradFi world, virtual currencies, they present a dilemma. If you think about financial services, it's a constant balancing act between, as the sort of old saying goes, greed and fear. At least in private sector driven economic systems, banks and financial institutions exist to make money. They also provide sort of a utility function in the economy, because without a regulated financial industry, the existing economy we had would collapse. Now we can talk about the future economy, Web 3.0, but the existing economy we have would collapse. So there's a utility function, there's a social function, and there's a raw capitalist make money function. And these often conflict. Today versus, say, 6 or 7 years ago, one big change is the amount of interest, public interest in cryptocurrencies.
Yes.
So if I look at, Rehan, I've talked about the value of this world is now more north of $2 trillion. Now, in a global context, believe it or not, that's still small. Estimates of financial assets globally vary, 250 trillion, I've seen estimates. If you add in real estate assets, you're looking at global wealth is often estimated to be about 450 trillion. So 2 trillion compared to that is still quite small, but it's still 2 trillion. That's still a lot of money in anyone's book. So if you're a financial institution, an executive, a board member, it's something it's hard to say it's irrelevant. We can ignore it. It's actually so big. Then the other factor is in many countries, and obviously if you're listening to this in India or other parts of Asia or in the Middle East where I'm based, the population is young. And there's a very different dynamic between if you're in your 50s and 60s and a senior manager of a bank or a board member, and if you're 18 to 24. If you're 50s or you're 60s, you're still sitting there going, is this real?
Yes.
Bad people use it. And then we have to remind ourselves that every new technology initially has somewhat, it's not a technical term, but you could say somewhat sketchy uses. I mean, my favorite is like the use of the telegram, which was like, like the internet of the day, right? I mean, in the 19th century and the early 20th century, being able to send messages, even though very short, that was revolutionary. Telegram, telegraph, the development of the telegraph was, in a way, we still talk about wiring money. Like, you don't wire money, but it's, but actually the use cases initially, it's either used by the military, if it's, let's not go into politics, but that could be a good thing or a bad thing. It's used by the military, or it's used by businesses with the highest profit margin. So I think when the telegraph was first rolled out across Asia, the first recorded use cases was to send drug prices. Now, it was not illegal in the British Empire.
Right.
In the 19th century. It was actually a very large part of trade, but sending opium prices is one of the first use cases. Now, so a lot of people look at decentralized crypto and go, they're all these bad people. And it's true, particularly in the early days, the percentage of crypto transactions that was black or gray economy was very high. Now that's gone down. That gives more comfort to banks and institutions, but there's still this gap, a cultural gap, and also a regulatory gap, because in many countries, regulators still haven't. The banking regulator hasn't said, this is legal, this is halal or kosher. Still, in many countries, it's still like, we're working it out. And if you're a bank, and I said before about bank responsibilities, liabilities, senior manager regimes, if your regulator is saying, we're not sure, we're working it out, you're not gonna volunteer to step in front of that potential legal bus. Now, obviously there's a client demand, so non-bank institutions have stepped up. In the US, you have, and in Southeast Asia, Rehan zooming in from Southeast Asia. I mean, there are lots of regulatory sort of rules. So here in Dubai, there's the rule book from the DMCC. In Abu Dhabi, the offshore regulator, the ADGM, has a rule book for digital assets. I've spoken recently to companies in Malaysia and Indonesia, crypto companies, and they have, either explicit or implicit approval from their authorities to do regulated business. And what's super interesting, I was talking to one such company just a couple of days ago. Half their clients are between 18 and 24.
Right.
Now, if you're a bank and you're a 50-something guy or a girl running a bank, and you're looking at these kind of stats, you have to engage, because otherwise the next generation, you're going to lose the next generation, but you can't run ahead of the regulators. So there's this kind of this tango or duality going on. So compared to 5 years ago, banks are like, we need to look at this, but there's still a lot of wait and watch going on. CBDCs are like probably the way that a lot of traditional banks will interact with the world of programmable money, because CBDCs obviously by definition come with the blessing of the government, the central bank. So banks will become the distributors of CBDCs. But even there's a challenge for banks, because regulated non-banks, so payment companies, obviously in India, I mean, the payment rails in the last 5 years of consumer has just completely changed, transformed. In a way, it's like India is just like a massive, wonderful case study for the sort of the explosion. That was the heterogeneity, the explosion of color in the payments world, from a pretty black and white world 20 years ago, 10 years ago, a bank-driven world and a central bank-driven world, to this, profusion of different options you have to do payments. Those companies, those digital wallet providers, those tech companies, those platform companies, they could well become distributors of CBDCs as well. And sometimes they will have an advantage over banks, because they're better at, not always, but sometimes they're better at building product, digital product, and they have more experience of rolling out new products. So it's a super interesting sort of landscape for the traditional banks. Bottom line, you can't ignore it, but they'll generally be followers, hopefully fast followers. My fear is that they could be quite slow followers in this space.
Okay, noted your points, valid points, Ronit, and I think it's a great learning. But the time is up. Watch is ticking. We crossed more than 30 minutes, and I didn't even realize that. But but let me take one strong question with both of you, and I will take it from where we started. We started talking about the future of the virtual currency. I will still take the same question, but I want you to give me a perspective. We have seen a major development specifically. I mean, we are in a much better position if you look at the development or a growth in this particular segment than what we were 5 years back, right? There are a lot of exchanges working for the cryptocurrency. Regulators are also at least thinking about it now, which 5 years back they were not even thinking about it. So considering where we are today, how do you see the situation for next 3 to 5 years, specifically in the virtual currency space and the digital asset space? Ronit, I will start with you itself.
You know the old joke, don't make forecasts, particularly about the future. So if they listen to this in 3 or 5 years' time, people will be laughing at whatever we say. But I think you're just going to see more of an acceleration. The last couple of factoids I mentioned, the younger generation and large parts of, whether it's India, Southeast Asia, most of the population is below 30. Their view on this topic is very different to sort of my generation or even older people. So we're sort of we're living in a super interesting period of time. This is exponential change. A friend of mine recently published a book, plug for his book called Exponential. It's like we're in this exponential age. Things are really speeding up. There've been amazing transformative technologies in the past. I don't want to downplay modern medicine, electrification, the steam engine, but what's happening now is that it's all happening together. And it's happening at a really fast speed. And so that's why it's almost impossible to make predictions. Now, I'm sure Rehan is much smarter than me, so I'm going to give him the hospital pass of trying to predict the next 3 to 5 years.
Yes, Rehan, please go ahead. And I'm sure Rehan will have a different perspective here because he's working with the stock exchange. He has a different portfolio altogether and handling, different verticals altogether. So Rehan, ball is in your court now.
Sure. So I think, the old saying, right? You always overestimate what's happening in 2 years and underestimate what's happening in 5, right? So I think Ronit mentioned a very, very interesting trend, which is the exponential age, right? What I haven't seen so far is, and I wonder, what is a game changer that really comes into the financial industry to unlock value that's just not there today, right? So I think when you look at crypto, et cetera, obviously it's on an upward path, right? We've moved from X billion to 2 trillion today for digital assets as a whole, right? So no question about that. And I think the growth is going to continue from its current investor base and hopefully from institutional adoption as well. What I wonder to myself is, at what point do enough assets become programmable? And how does that network almost become viral, right, in terms of expansion? So that super app is yet to come, right? I'm sure someone is working away on it somewhere in the world right now. But I see actually you mentioned digital assets versus currency. I think the currency train has already left the station. I think the train that hasn't left the station yet fully is really the assets and more the programmable assets. So I see the juggernaut that I think is coming our way is the ESG-centric programmable asset that is really able to unlock value from large financial institutions and make them more accessible both to institutional investors and accredited and retail investors. I don't think we've seen that super app just yet, right? And I would fully agree with Ronit that when it comes from a distribution standpoint, both from a currency and an asset standpoint, it'll likely come in through some very unconventional players, right? Essentially players that have very good, B2C networks, and again, are able to deploy at a very different speed to financial institutions, right? So again, very excited about the future. I think when you look at the financial world, today we're very used to thinking equities and bonds and currencies, right? I think in 5 years, people will be talking about an ESG overlay onto everything. They'll be talking about, trade finance-like assets. They'll be talking about loan-like assets. And frankly, it's really good for the end investor, right? you get away from your typical 60-40 allocation bonds stocks, right? You start thinking of a wider array. So I'll just pause. I'll just stop there. At the risk of being laughed at in 5 years from now, but that's my big picture view.
Noted your points, Rehan, and I think some meaningful insights. I'm sure the participants, attendees, those who are attending this particular session must have enjoyed, listening to your views, and it's quite what you can say unusual to discuss even these things. While regulators and BFSI companies are also going slow, and everybody is trying to be very protective when you're talking about this particular subject. So thank you so much, Ronit, and thank you so much, Rehan, for sharing time. I know it's very difficult for both of you joining from different regions to share your perspective on this platform, but thank you so much for your meaningful insights, Ronit and Rehan.